Last year, we saw an interesting shift in crypto. First, all of the trading happened on the Solana chain with the pump.fun ecosystem. It was meme coin trading. Then afterwards, we saw attention gradually moving to the Virtuals protocol on the base chain, which subsequently also went to Solana. Now the question is, how much higher can Virtual go from here? Is there enough upside potential? Let's have a look at the usage statistics. Let's have a look at the data most people are not considering. Now this is not the first video on Virtuals on this channel. I've published several videos before. The very first one 228 days ago. That was when the price was still at 41 cents. We subsequently had a massive run to almost $5, the subsequent correction, and now we recover again. The trading fees through the Virtuals platform also see a similar shape. A massive run, subsequent collapse, and now a slight recovery. The trading of the virtual token itself also massively ballooned, crashed down, and is now slightly recovering. So there is some kind of an alignment here, right? The price moves together with the usage of the protocol, with moves in line with the trading volume of the token itself. Now Virtuals has launched a ton of tokens. And of course they all have their own price discovery. But the ecosystem as a whole, it tends to move very much with the virtual price itself. So have a look at this. The market cap of all the Virtuals protocol ecosystem tokens went up by 13.3% in the last 24 hours. The virtual token itself went up by 12.2%. So very similar today, very similar pretty much every day. And the reason for this is how the liquidity of most of those tokens are bound with Virtual itself. So on the decentralized exchanges where those tokens can be bought, it's normally swapped versus the virtual token directly. So when Virtual goes down by 10% in US dollars, automatically, without a single trade having happened, all those altcoins also go down by 10%. Here, have a look at this. When we search for buy Virtuals on DEX Screener, we can see how those liquidity pools are all against the virtual token. So the ratio of the altcoin relative to Virtual is what determines the price. And if Virtual itself is going down by 10%, the altcoin is going down by 10% as well, automatically. That's why the market cap of the ecosystem is that closely coupled with the virtual price. Now, the virtual protocol tokens are coupled to Virtual. Now, Virtual is coupled with Ethereum. So when you buy virtual tokens, that's against the Ethereum in the liquidity pool. And so let's have a look at Virtuals relative to Ethereum. That's this chart over here. It looks like we might be in somewhat of a range, and there could be a lot of resistance to the upside and potentially less resistance to the downside. Let's have a look at the most traded of the AI agents on Virtual. It's AIXPT with a daily decentralized exchange trading volume of 5.1 million. And here is AIXPT relative to Virtuals. So unfortunately, a long-term underperformance. Yes, there are sporadic rallies every now and then, but if you decide between AIXPT and Virtuals, it probably makes sense to rather buy Virtuals. But does it make sense to buy Virtuals itself, given its relative valuation to Ethereum? Let's dig a bit deeper. Now there's a potential problem with the tokenomics. So far, the number of virtual tokens has not changed over time, but there is a potential unlock. The total supply of Virtual is 1 billion, but currently only 650 million are floating, and the treasury will get an unlock of tokens very soon. What will then happen with those tokens is unclear. Now Virtuals has a staking program, and staking the token might make sense because of all the advantages one gets on the platform. And staking is good for virtual holders because it means that the supply, the liquid supply, is contracting. So a staking program helps support the price. The problem is that the staking has slowed down recently. In the last few days, we saw people unstake their Virtual. And this is not good because unstaking usually means that the tokens directly get sold off. The good news is that the amount of staked Virtual isn't really that high compared to the entire supply. It's only 3.3%. So even if everything gets unstaked tomorrow, it won't crash the price. But it's unfortunate we don't see this further expanding, because that definitely would help the price as well. Let's get into the on-chain metrics and let's focus on the token on Base. We've got Virtual both on Base but also on Solana, but most tokens are still on Base. This is where the majority of capital lies. And on the Base chain, we've got 688,800 wallets that hold some amount of virtual tokens. Now, a lot of those wallets hold only very small amounts. What we see here on the left is the number of wallets that hold at least 1,000 virtual tokens. That's a bit under $2,000. In the middle, it's 10,000 tokens. On the right, it's 100,000 tokens. So it's a 10x each time. So on the left side, I'd call this the retail investor. On the middle, I would call this the medium-sized wealthy investor. And on the right, we've got the whales. The whales proportionally went down the fastest in numbers. So the whales tended to sell off. There's no accumulation with any wallet cohort, but the whales are really quite aggressive with reducing exposure. But how is it then possible that virtuals outperformed Ethereum since the beginning of April of this year? I think the answer is leverage. Just have a look at how much more open interest there is in virtuals now. With the first rally, open interest was very, very slow because the price appreciation was caused by the spot market, by people buying into the token. The secondary rally was not anymore caused by the spot market. The spot market rather sold. It's all just leverage. It's short-term leverage. And I think this is rather dangerous, right? Because perpetual futures investors, they don't buy into an asset in order to hold it over many years. They simply just want to get short-term levered exposure. And that exposure will get reduced at some point. The masses are not getting in anymore. It's simply just a few big whales that push up the price via leverage. And so I'm not really a fan of getting into virtuals right now. The potential risk to reward relative to Ethereum isn't great. And yes, when the price was still at 41 cents, things looked nice. The leverage at the time was extremely low. But the situation now is different. We're not just at a few cents. And the leverage is much, much higher. And even if you're making the argument that the valuation relative to Ethereum might not be great, it's also not that great relative to Solana. So the potential risk to potential reward is not really worth it. The Virtuals protocol had been a great investment this year. Will it be as great of an investment in the next 12 months? I am not so certain. I try to keep things as objective as possible. I don't just always shill a cryptocurrency just because you want me to say something positive. Yes, I might not be right, but I'm simply just sharing the data how I see it. Now, the vast majority of people in crypto approach the market in the wrong way. Most people try to find those multiple X returns. They try to find the few assets that make outsized win. But this is clearly a game against the odds. Most altcoins tend to go down massively. A 70% decline over here, another 80% over here. It's all double-digit losses. Now, the common counter argument is that maybe we don't just buy one or two altcoins, maybe we buy multiple and then we might get that high flyer as well. But the problem is that diversification, so spreading the risk across various assets, does not work with altcoins. Everybody can launch an altcoin. Everybody can increase the supply as they want. And so in aggregate, the altcoins tend to do worse compared to Bitcoin and Ethereum over the long term. What we've got over here is the others dominance. So how much of all of crypto is in the altcoins that are not in the top 10? And 3.5 years ago, this was still at 19%. Now it's below 8%. So had you invested in a broadly diversified basket of altcoins, you would have on average underperformed the market by 60%. Instead of trying to find the needle in the haystack and most likely lose, at least in the long term, isn't it better to try to get the odds in our favor? If most things don't perform that well compared to Bitcoin and Ethereum, if a lot of altcoins inflate in supply over time, so supply grows faster than the demand, then why don't we bet on relative valuations? It's a bit more complex of a game, but I believe that this added complexity does help. We want to make our investing as simple as possible, but not simpler than that. And so here I am doing something differently to most other YouTubers. Most crypto YouTubers, they just show one single win. They say, here, I made some money over there. Just trust me, bro. Very few are willing to share their trading history. Now, here's my trading history on Hyperliquid. This is where I started trading decentralized perpetual futures. This is the profit and loss. And the maximum drawdown was only 5.1%. Now, obviously, I'm not going to share my positions open here on YouTube. That's part of the premium membership. It's down below. It's thebitcoinstrader.com. Now, the issue with trying to pick the winners is, of course, that we have a very low chance of succeeding. But the beauty of crypto is that it's still an incredibly inefficient market. People always say that capital markets are efficient, but in the end, it's the people that make it efficient. So if you know more than the average market participant, if you do more research than most people, if you're part of a group of people that do more research than the average market participant, then we can win. Then we are the people that make the market efficient, then we are the ones that make the profit. For example, this here. This is pure inefficiency. This chart shows the balancer token relative to Ethereum. A very constant underperformance. And we can make money from that underperformance. As the price is going down, we are printing money. Yes, we are betting on falling prices. And yes, this might be a bit more scary at first if you don't know what you're doing, if you haven't yet learned about this whole topic. But the risk is every now and then a potential short-term pump, again, when we bet on falling prices. But the reward is a very long-term constant trend. We can also turn this chart around. So this is now Ethereum relative to balancer. So basically buying this when we long one asset and short the other. So the inefficiencies are not necessarily that obvious in the macro, as in the market is expanding and contracting in a way that's not that predictable. But the relative valuations are much more predictable. The risk to reward in a chart like this is quite obvious, isn't it? People make all kinds of mistakes. People, for example, also just leave their stable coins in their wallet, right? Let's say you trade actively, you've got some stable coins and you don't use this for anything to add some additional return. That's also a mistake. For example, here we can get 15% APR by providing liquidity to Hyperliquid, the largest decentralized perpetual futures exchange. It's comparatively safe. It's definitely worth the risk for 15% APY. And so this is then the feedback that I get in the chats. It was the first nice trade. Thanks, Gerhard. And over here, a few more positive trades, etc. And people make their money back very quickly. Premium has already paid for itself. And yes, if you've only got a few $100s in crypto, this is probably not worth it. But if you're investing several thousands of dollars and you're still inefficient in your trading, if you still hope for your one altcoin to outperform, it probably makes sense to learn a bit more. And this is what I mean by learning. I've published more than 100 tutorial videos on various topics within crypto, on how to use relative valuation bets, on how to manage risk, on how to do on-chain analytics. Feel free to binge watch all of this. And of course, I'm also sharing my own trade. So for example, here is a trade opened on the 30th of April. And here's then how I closed this 5 days later. Yes, this is only a single example, but that's why I showed the overall portfolio chart before, right? This one over here. And so feel free to check it out. It's currently $125 per month. It used to be 165 when everybody was super hyped about crypto. Currently, the attention on crypto is rather low, and so the price is also lower. If you lock in that price now, you will not be affected by the price increase that might happen once the market picks up again. So everybody that signs up locks in their current rate. If it's your first time here, feel free to subscribe. I publish here regularly. Like would be very much appreciated as well. It helps the channel grow. See you next time on YouTube or see you in Premium. There should be somewhere a card over here. You can just click on that and it will lead you directly to the sign up page. So see you over there as well. Cheers.